Hi, I'm Stephanie Link from The Street.
And I'm Colin Gillis from BGC Financial.
And we're here to talk tech.
Like we always do.
Absolutely. So let's start with Apple. You have made this brilliant call to upgrade it ahead of the quarter.
It was scary. Sweaty palms, that June quarter guidance, you know.
Sweaty palms.
Yeah.
Turned out to be a kind of crummy quarter, kind of crummy guidance.
Well, we knew it.
We knew it.
Maybe a little more crummy than people were expecting.
Yeah, and we know that the stock is working now because of the aggressive share purchase and the buyback and the shareholder value creation story game. I want to talk a little bit more about fundamentals. Should we own more of this stock now because of the upcoming products, or do we have time?
You know, the date I would march is their developers conference in June, right? It starts June 10th, and that's when you're going to get your first look at the new iOS 7 that the designer Johnny Ive has taken control over. And let's see if he brings a fresher, cleaner, more sleek design to the iOS, which some people feel is dated. So that's likely to be a catalyst. Plus, if you look at how the stock is trading now, when you have that size of a buyback in the marketplace, right, it just puts a little bit of support into the bid.
Is the iOS, is it a needle mover to you?
We're in front of the whole refresh cycle. And what happens if we do get the iPhone 5S, announced at that time? That one more thing. Right. I've heard a couple of reports saying that pre-sales could happen as soon as June 20th. Most people are expecting it later on in the fall, but we know that the refresh is coming. We are past that June quarter guidance hurdle that was scary for so many people. So I don't have a high price target. I've got a $500 price target. So if you want to jump in now.
Okay, let's talk Amazon. Are they ever going to make money?
Wow, Amazon, talk about finally underperforming the SPX.
It's really broken down. We were talking about this offline. It's really starting to break down. The valuation really is extended for what you're getting in terms of quality earnings.
The bull case say, hey, they own all of retail, and let's look at Walmart as a proxy for retail. So that means there's probably a double left in Amazon, right? But the bear case says that, hey, these shipping losses, instead of abating, have now ticked back up again, and that even if you use the $10 in EPS that people were modeling for 2015, it's trading at 25 times. That's not inexpensive, and the leverage is not materializing. And as the revenue slows, it becomes an expensive stock to own.
So will they ever get positive operating leverage in your mind?
To a degree, right? A retailer earns 5% margins typically, right? And if they can layer in some new businesses like their advertising business, I'm actually very positive on, that runs 30% margins or so, then that could kick in a little bit more. AWS, their web services, great business, but it's also going to be a low margin business. See how many times prices have been ground down. Big business, but low margins.
More M&A from them?
They always do M&A. They do tuck-ins. I don't think anything's massive. They don't have a ton of cash. You know why they don't have a ton of cash? Because they don't generate a ton of cash.
That's right, because they're a retailer. Okay. Well, that's great. That's great advice from Colin, and look forward to next week.
Buy Apple, stay away from Amazon.
Sounds good.